Right now, we have U.S. stocks trading just shy of the record highs from earlier this week. However, though Citi is warning of near-term downside risk to equities, much of that coming from President Trump's policy effects. Joining us now, we want to bring in Citi's head of U.S. equity strategy, Scott Kroner. Scott, it's great to talk to you again. Thanks so much for making the time to join us here this morning. So talk to me about that downside risk. What does that look like?
Well, Shauna, I think, the conversation you just had with Josh sets up, I think, a bigger issue. And that is that as we look at where the S&P is trading currently, 25 times trailing roughly, 22 times forward earnings, near an all-time high, the market has been deservedly focused on Trump policies all told, right? Tariffs gets most of the discussion because of its seemingly more direct impact on fundamentals. But the package in its entirety, combination of tariffs, potential for tax reform, which is probably more of a 26 event. Then you go down the deregulatory path, which is still, I think, to be defined. But then you have this new element, courtesy of Musk and Doge, where you're now focusing on ways to streamline, make the government process more efficient, which essentially means at some point a potential end to the fiscally positive impulse that we've had in place since the pandemic ended. So our point here is that as you look at the starting point, you look at what probably has yet to be priced in from a fundamental perspective. Our view is that there's still upside for the S&P between now and year end, but between here and there is probably an ongoing period of volatility concern that keeps us looking for pullbacks as better buying points.
Okay, so does that positioning, and as you're kind of laying out all of these different issues that investors are watching for, does that mean you should be more broad market focused to try and hedge some of that volatility, or does that mean you should be in a stock picker's mentality looking for the names that can benefit off of each of these risks that you mentioned?
Well, Brad, the latter for sure, okay? But I think the other element of this, we're talking about macros, and again, the conversation is kind of centered around that. In the meantime, what we're also focused on, which has been written up in our note this week, is that if you look at the Mag 7 component of the market, okay, you're looking at a weight that's, let's call it a third of the S&P index weight. In that case, probably a little bit less sensitive to the broader policy spectrum, probably a little bit less sensitive to the immigration concerns you were talking about. But importantly, on a standalone basis, that part of the market has been showing a decelerating pace of beats and forward guidance raise to expectations. That's an issue. When you're trading at the heady valuation that most of those companies are, our concern becomes that you lose that leadership, which is okay as long as the broadening that we're talking about offsets it. But if you look at the way the years have unfolded so far, you only have one of the Mag 7 actually outperforming. So the broadening is happening, but what I'm saying here is that you need both legs of this to work. You need the broadening effect, which is, I think, a real intrinsic positive for U.S. equity fundamentals, but you also need that Mag 7 to continue to contribute, and that's where we're getting a little bit of pause right now.
Yeah, and Scott, just bringing this back, I guess, to Fed policy, and obviously we have seen this bit of a rotation. There is questions just given the fact that we haven't seen the broader participation from Mag 7, but then coupling that with some of the policy initiatives that you were talking about from Washington earlier this week, where does that leave the Fed? And I guess how tough and how complicated of a decision and another path forward the committee has at this point, trying to determine what is the appropriate and right timing of that next step?
Yeah, so what we've learned from the Fed, they've been, quote, data dependent for years, it seems like, right? So I don't know that the Fed's going to move in anticipation of Trump policy effects. I certainly wouldn't expect that. I think where consensus is currently for a cut or maybe two as the balance of this year unfolds is appropriate. Again, we've talked previously about the S&P pricing in soft landing and Goldilocks. Goldilocks gets upset if you move down a path where the Fed is actually in a position to tighten. I don't think that's the case. We don't think as a House view that as a case, but it's certainly a possibility that we have to keep an eye on. But my point here is that if in the background, I'm a little bit more concerned about aggregate consumption, courtesy of Trump policy and some of the immigration and other measures you talk about, I'm incrementally less concerned about the Fed. So I'm okay we're okay with a 10-year in this 4.5 range, plus or minus. I think where we get a little bit more nervous is if you see rates back up towards the 5 handle. But again, the countervailing force on that is that you're taking a little bit of pressure off of forward expectations on yields, courtesy of some of the initiatives to look at ways to streamline government spending, which really were not in the policy discussion several months ago.
Scott, let's talk a little bit more just about that risk side of that scenario. If we do see the 10-year yield move back up to that 5% level, I guess what would be the trigger of that potentially?
I think it would have to be this. It would have to be, sort of a shock that you're seeing under the surface. Natural inflation pressures tick back in, and then you combine that with the perceived risk of tariffs. Right now, the tariff discussion is important on this because as the discussion has been out there for several months now, many investors quickly go to, oh, this is an inflationary issue, because the expectation is that corporations will essentially take the tariff cost and pass it through in end prices. We question that. I'm not as concerned, honestly, about inflation as I am with the gross margin risk of companies not being able to pass it through and having to kind of take a gross margin hit in turn. So there's a lot of countervailing forces here, Shauna. Very difficult to say how it's specifically going to play out. I think we certainly have to be aware of that tighter for longer Fed narrative. But as we've learned over the past couple of years, a higher Fed, more hawkish Fed policy doesn't have to be necessarily negative for stocks as long as there's a fundamental offset. In the past couple of years, it's been the Mag 7 and the AI push has been that fundamental offset. So, we've got a balancing act here that I think if I'm going to kind of, pull this all together, it kind of comes back to the starting point. What's happening right now in the market, in our view, is that individual stock and industry group activity is where you're seeing the expectations for rates, the expectations for Trump policies to play through. But so far, it hasn't been an all-in index issue.